The CPI print came in hot, red hot, and we gapped down 50 points in the ES. The market must be crashing, right? The bubble's gotta be popping, right? Well, not so fast. Let's take a look through the data points and answer that question objectively. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So starting our very objective look at the SPY daily time frame chart, what do we see here from a trend point of view? This is always the first question that we ask. We're keeping it simple. We've got lows, higher lows, and I would argue that we now have firm daily higher lows. Remember that in here we had soft higher lows because we never actually flipped into an hourly downtrend. And of course, along the way, we had highs, higher highs. And on Monday, we actually broke out, although we didn't close strong, but we did make a new higher high in the trend count, a new all-time high as well. So pulling back from the highest high in the trend sequence, as we talked about on Saturday, we were willing to give the buyers one more shot at 491.50 because this was not a firm daily higher low. And lo and behold, no pun intended in hindsight, we can see that now this is offering a clear higher low. Buyers obviously stepped up in the lower wick of the Tuesday session, and now we're higher on the Wednesday session. Again, think about structure here. So structurally, hammer-esque style bars, buyers stepping up in those lower wicks are very important here on the daily because now we have prior resistance in this little interaction here, now acting as support, being confirmed as support as a new daily higher low, firm higher low. We were definitely in an hourly downtrend on that 50-point gap down. And now we've also got support happening here at the Monday and Tuesday highs of last week, which would have represented a gap fill reversal if we had used that area as potential support on the Tuesday morning open. That's the next thing to point out, that there's a lot of confluence here. Tuesday morning's open is right at the gap close, basically, as well as the lower edge of this week's expected move. The gap close level was technically at 494.30. That's exactly where we found support at the lows of today's session, and we've closed green over the opening print and about halfway through the original gap in here from that Tuesday morning session. So on the daily time frame chart, from a trend point of view, if we're being very honest with ourselves, is there any damage that has been done here that would suddenly start to suggest we're flipping into a downtrend? Do we have equal lows? Do we have lower lows, lower highs? The answer is objectively no. If we ask ourselves about structure and any strong indications of sellers stepping up here, we will of course concede that the gap down is bearish. But what do we see intraday when it matters, right? Buyers are stepping up and turning prior resistance into newfound support. So I would add one more X over here that says no. Trend-wise, there's no risk of a downtrend, and as of right now, there's no structural evidence that sellers are stepping up with a lot of strength. Let's get even more forensic and start to take a look at the hourly time frame chart while still remaining objective in the analysis. As we open up on the Monday session and this break takes place, obviously we know that's what sets the high. The Tuesday gap down offers a lower high from there to there, and from here to here, of course, we also have a lower low. Into the end of the day, we also see another lower low, and we close underneath the high of day. So at this point, we are technically in an hourly downtrend. What are we in currently? If we're looking at the trend, again, objectively starting from this low, we have a low, and this would be a higher low. From here, we had a high, and now we have a higher high, and into the close, we have a higher high, hence the green close on the daily hammer, right? We closed near that high of day. So we're starting to drift back into an hourly uptrend here based on the sequence. That, of course, has to be bullish. Let's also talk about the failure of the sellers at this junction right here. As we can see, this was very difficult to participate in. It's not like we looked at 491.50 and said, oh, we're just blindly buying this down here. It was an end of day ramp that really caused the move back in the upward direction. So let's say that it was very difficult to participate there, right? So on this morning's open, on the gap up, is there an opportunity for the sellers to offer a continued lower high? The answer is immediately no. With the gap up this morning, we're moving over the previous day's high, and there is no threat of a lower high underneath, and then another instant equal low at 491.50 for an equal low breakdown, and then we continue the hourly downtrend, and we jeopardize the daily trend because at that point we would be underneath the line in the sand, which we've talked about now a number of times at 491.50. So if the sellers were truly going to have an edge, an open down here, or an immediate drive to the downside that found acceptance in this level, maybe we could argue lower high, right? But for now, considering what's already unfolded, this is instantly a higher high on the open. And now our job is to just say, okay, where is there an opportunity for a higher low? And you should have been paying attention to this level at 494.30. And you can clearly see it was the opening print of the Tuesday session. It is the lower edge of this week's expected move. And it was the bottom of this gap from over here, the Wednesday session from last week, right? We gapped up and over, and that level remained untested. So you can see as the market pulls back to close the gap from this morning, because again, we did open on another gap in the upward direction, so that structure underneath us is not technically sturdy. The market pulls back, tests the level in that lower wick, and let me ask you the question, structurally, so we're not talking about trend right now, but structurally, is that bar in isolation bullish or bearish? Certainly the lower wick would suggest that buyers stepped up near the lows and the sellers had absolutely zero, nothing going on. There was no weak close down here. We did not get a solid red-bodied bar. Again, if there was going to be a threat for a larger downside move, the sellers really would have wanted to see something like this, consolidation here, maybe setting up the break into the end of the week with something underneath 491.50. It simply did not take place. So as we're getting forensic, we're continuing to evaluate higher time frame trend, which is up. There's no immediate indication of sellers. Even here on the hourly time frame chart, we can see that in the lower wick of today's bar. We've closed on the highest high. So what does that mean for the continuation of the current trend? Well, if this, we're talking about from here to here to here to here to here, right? If this is the hourly trend that we're analyzing, now we know that a higher low can be found once again over 496. We're pulling back from the highest high in this immediate isolated trend count. So the higher low is on the table and 496 makes a whole lot of sense for it. Why? Well, first and foremost, it's going to continue to be the high of the Tuesday session. Remember that, before today, this was the gap. So holding over 496 makes sense from that perspective. As we continue to look left, it's the Wednesday test to the downside. Remember, if there were stronger sellers in this market, they would have had no issue closing this gap. It simply did not take place. We moved higher, right? So you get that low. It's also the Friday high from 2 weeks ago. So 496 has a lot of price history around it, and I can envision this trend continuing in the upward direction if there's two-sided trade in the first place on a higher low pullback over 496, looking to align with a move to close the gap to the Monday lows and then follow through into the all-time high basically up here at 503. So that's what the bulls want to see into the end of this week. We want to turn this. You could even just, I know there's going to be a lot of flack in the comments from the pure pattern traders, but let's just call this a double bottom. Call it whatever you want. If we get a pullback from here, this is a higher low double bottom, break the neckline, aka bring in some sort of higher high, and we have thin structure to retrace, right? You could also make this comparison as well. When we were gapping and going in the upward direction, there was really no issue. The sellers would not, there was no gap close below, so no indication of stronger sellers. Now that we have a gap down, sure, we got a little bit of follow through here, but if that trend was going to flip, if there were not going to be stronger buyers in this market, we would think that this gap would remain unfilled, and that's clearly not the case. You can see that we've worked more than halfway through it on today's session. So again, when we're trying to assess who is in control of this marketplace, I think that all of the evidence really points towards the buyers still, even after the CPI gap down. Let's take a look through the lens of the anchored view apps intraday. Notice that this is just absolutely phenomenal. Confluence at 496, the all-time high anchored view app paired with this one from back here on that higher low. You could call this bull flag breakout where the consolidation maybe began from. You'll also notice that a line in the sand now is going to have to be this. You can't really afford for a lower low underneath that. Otherwise, let's flip the script here. Before we do it, let me just finish up the confluence with, of course, our Fibonacci from the low up to the high. And what you'll see is we have beautiful 38.2. Again, it's golden, right? So 496 makes a lot of sense here. It's anchored view apps, 38.2 prior structure, and look at the low of the move right to the 61.8 Fibonacci, which is the line in the sand, right? If we were to spend time underneath the 61.8, the odds dramatically increase for a 100% retracement. It simply did not take place. All right, so we know what we're looking for to the upside. That's fairly straightforward at this point in time. What do the bears want to see? If we're going to flip the script here and say, okay, bears, we'll give you the benefit of the doubt. The bears want to see a daily lower high. It could be a gap fill reversal, or it could just be a straight up rejection back down to these lows, but I would not really participate in this area as a bear, right? We've already talked about why and how the 496 higher low continues the hourly uptrend here. But what the bears want to see is this to this, let's just call it that, lower high, and then they want to see a breakdown for an equal low. Now that we've pushed away from this on the daily time frame chart at 491.50, we do not want to revisit the equal low, because from there, now of course you have either a balance or after a lower high, which would be what the bears would prefer, this lower high equal low reattempt opens the door for downside, and now suddenly we start to risk a daily downtrend. We're not there yet, and it wouldn't be top of mind based on all of the evidence that we've seen so far and we'll continue to walk through, but that is what the bears want to see. They want to see a rejection here for some sort of lower high, not getting to the equal high, and then they really shine. Let's even bring out the red crayon for them. They shine underneath on the break of 491.50. Let's dive into some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. And let's just take it very simply day by day. Monday, we know that price-wise, we're making a brand new all-time high, even though we did pull back aggressively into the close. Volume flows would substantiate that. Same thing with the advanced decline line in trend higher zone. And the cumulative tick, although not blockbuster reads over positive 5,000, certainly a strong show, strong display from our buyers on that Monday session, supporting the new all-time high that was produced. Tuesday, we know that's the devastating day. No surprises, volume outflows here. One thing that I would point out is that we did not actually flip the cumulative net volume flows on the week substantially bearish. I mean, yes, it did flip red, but nothing net on the week that was like, oh my goodness, run for the hills. Obviously, you're over-correlated to the downside here, and the cumulative build really accelerates into the close here, even as we're getting that end-of-day little pop. So, of course, sell-side activity checks out there. No surprises. Today's session is really what counts. Today is the follow-up to the gap down. Notice that we had strong volume inflows getting up and over 300 million into the close, flipping the net read positive for the week. The advanced decline line most of the day is in trend higher zone, and the cumulative build is a 45-degree line, not something that looks like this. Remember, when you get a cumulative build that looks maybe something more like this, that's always indicative of a short squeeze in the morning. This is not a short squeeze. This was sustained buying pressure at the exchange level all day long. And that's, the beauty of that 45-degree line in the cumulative tick. Now, one thing I want to caveat this sort of analysis with is the new indicator here, which is going to be an additional bolt-on to the quad. It's the index score. It's a blend of different sort of metrics that I'm tracking here. But look at what a strong read looks like. That's Friday of last week, right? We know that the market also broke out on Friday of last week for a new all-time high. That's beautiful here in the index score. If you look at what happened on Monday, not the strongest all-time high. Now again, let's balance out the analysis. On Tuesday, it's really not the strongest sell-side indication either. It wasn't so obvious that Tuesday was a short. Now today, again, balancing out the bullish nature of maybe the positive AD, the 300 million plus volume flows, and the beautiful 45-degree line, we really didn't have the strongest display of the index score today. Now, this indicator, again, is in forward testing. It's not something concrete that I've back tested for years like the other components here, but this just, again, sort of balances the analysis and keeps us very, what's the key word? Objective. Exhibit B is always the market profile. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's keep it very simple for today's session. We want to focus on the value area from today as well as the Tuesday gap down day. What you'll notice is that they're overlapping to up here, but they're lower in the session, and this is higher on the Tuesday session. But the point being is that we talked about an hourly higher low pullback on the candlestick charts, and we talked about Tuesday's high, 496, acting as the key level. In the ES futures, loosely around 49.95. We know that's the level that we've been tracking. The point is, if we pull back, and again, there's no suggestion of a pullback on the hourly chart or daily chart, but if we pull back, it's going to be much more difficult to turn these folks into overhead supply. As a matter of fact, they're getting another opportunity to possibly re-enter long positions or reevaluate what they want to do. Do they want to add size? This only turns into overhead supply when and if we break down underneath the low of day, today's F period, basically. And there's another really strong component here that helps add into the narrative of, do we have stronger sellers? First and foremost, great excess low in F period, but it's a mechanical low because it goes directly to the point of control of Tuesday's session. So ask yourself this question. Who pays attention to points of control? Who pays attention to very nuanced and visual levels? It's short-term traders. So if we had longer-term sellers, strong sellers, let's say JP Morgan got an order across the desk, sell, I don't know, hundreds of thousands of ES contracts, right? Sell them all. We want to hedge this thing short. If that's the case, they're not stopping here at the point of control. They have an order to fill. Maybe they run a VWAP algo or whatever it may be. they're not going to stop at the point of control. So I do not believe, based on this interaction here, that we would have stronger sellers. I would also point out, while we're zoomed in, we have a great excess low on the Tuesday session. So for now, market profile aligns with everything we've discussed so far. No stronger sellers, an opportunity for a higher low, and it's not going to jeopardize instantly any of the players here because they're situated lower in today's trading range. Let's take a similar approach and walk through the QQQ, maybe slightly abbreviated now that we understand the concepts from the S&P. Let's begin on the daily time frame. Of course, from a trend point of view, we are in an uptrend with consecutive higher lows, now firm higher lows at the 426.25 level. Remember, these were not firm higher lows. We did not have an hourly downtrend. The gap down certainly was an hourly downtrend. And then, of course, we're pulling back from the highest high in the trend sequence. We did get the new all-time high on the Monday session. The largest discrepancy here in the QQQ is this breakout point right here. And you'll actually notice in the upper wick of the Tuesday session, we closed underneath, right? That wick signifies some sort of rejection. The sellers really stepped up and kept prices underneath 429.25. So coming into today's Wednesday session, there was a larger threat for downside with the failed acceptance back above this key breakout level. Now, what do we know happens, of course, in hindsight? We opened above the level. You can see in the lower wick of today's session, we are turning prior resistance into even resistance here in the upper wick from Tuesday into newfound support. So just like the S&Ps, we have that bullish flip back in the upward direction. The hourly trend is trying to flip in the upward direction as well. This is also confluence with the lower edge of this week's expected move. So daily trend is certainly up. That is bullish. We had an indication that sellers were trying to make a stand, but today's bar is evidence that those sellers have failed. Is there the opportunity to potentially turn this into a daily lower high? It is technically on the table, but let's take a look at the hourly time frame chart and really examine how that flip might take place. For now, let's align more so with the bull side, understanding that in this nuanced interaction right here, we do have a low, higher low, high, higher high, and a higher high into today's close. So the next ideal higher low wants to be above the Tuesday high of day, as well as the Wednesday and Thursday lows of the consolidation from last week. That number is at 431.50. If you can get consolidation here, that is totally bullish continuation of this isolated trend sequence. Now, where, of course, do the bears get their upper hand? This level should be clear as day by now. It's this level right here at 429.25. If we were to flip underneath that, now all of a sudden, this to this is a lower high on the daily, and you can even start to argue that this is looking like a head and shoulders on the hourly time frame chart, break the neckline, and the floodgates are open for lower. So that's the concern to the downside if the bears are going to take control. But as we've already walked through, objectively, looking at the evidence, there is no indication of stronger sellers getting active just yet. Let's not forget about the anchored VWAPs. Here we go on the QQQ. You are getting confluence at that 431.50. So again, the ideal higher low pullback respects the top of the anchored VWAP band. That would be picture perfect, not the end of the world. If we hold the lowest band here, which again is the retest of the equal low, it's not great, but this is okay as long as we're above, again, this previous area of big resistance, which led to the breakout over here. We basically don't want this to turn into a failed breakout look. We want this to be more of a successful retest of the level than push in the upward direction. Lastly, we've got the the Fibonacci's before I send you back to the old map video and you finish it up with the internals and profile. 38.2 has been recaptured. That does strike me as a slightly more bullish nuance here. It's not the cleanest confluence around this zone, and the 61.8 did hold perfectly at the lows of the Tuesday session. Just remember, if you spend more time underneath the 61.8, odds increase for the 100% retracement. Was not the case on Tuesday. Further, solidify that idea with a look at the market internals for the NASDAQ. You can see net flows are back to somewhat flat. Strong outflows, yes, just following it up with strong inflows on the Monday and today's Wednesday session. Way overcorrelated to the downside on Tuesday. Usually those style reads that are so severe to the downside, they cannot persist, right? If there's going to be any sort of rotation, they will not persist. And that's exactly what we saw in the rebound for today's session. Everything is now back up over the previous day's close. Strong cumulative build to the downside on Tuesday, and a small build to the upside on today's Wednesday session. So overall, internals would suggest that yes, some damage was done, especially with the understanding, as we discussed on the hourly and explored on the daily, with the upper wick rejecting that level, which was the key breakout breakout point, as we know on the NQ futures, it was 17,775. As we were rejecting that area, of course concerns were stepping in. The bearish internals were like, oh my goodness, this market is not looking so hot. But how did we follow it up today? Strong show of strength back in the upward direction. And again, back on that hourly time frame chart, nothing imminently suggesting that a huge breakdown is possible. The line in the sand, one more time just to reinforce the level, is at 429.25. Let's jump on over to the market profile for the NQ here, and what you'll get out of this is very similar to the ES, where the value area is lower, the value area is a little bit lower, point of control is central on that Tuesday session. So on Tuesday, again, think about it like this. There was more of an opportunity for the sellers to say, hey, we're accepting prices down here. Buyers want nothing to do with it. Near the highs, we're rejecting this move, right? This all-time high from Monday, we're rejecting it. Big gap down. Of course, interest rates are soaring through the roof on that hot CPI print. Not good for tech, right? So this, again, there were more threats out of the NQ on the Tuesday close, but today's Wednesday session sort of alleviates some of the threats. I'm not going to say we're out of the woods yet, but I would say that the daily trend is up, the hourly trend in the short-term sequence of 2 bars is certainly up. The value area is lower on today's session. So again, a higher low pullback that's respectful of that Tuesday high. It's going to be over the value area and over the point of control from today's session. A lot of the same concepts we discussed on the S&Ps apply here, but there was the stronger indication of weakness on Tuesday. Now that it's resolved in the upward direction, we're alleviating some of those concerns. We're not all the way there yet, but for now, if the sellers were going to make a stand, Tuesday was looking like the day to do it. Today was not the follow-up that sellers would have hoped for. And lastly, for our broad market indexes, we have IWM Russell 2000 and the small caps kicking it off on a daily time frame chart. If you're looking at this blob of price action here, might not be so clear what the trend ultimately is. Is this to this a lower high, or is it from here to here a higher low? So to get a little bit more clarity, I would always recommend you go up a time frame. And what do we see? Well, from here to here, we've certainly got ourselves a very clear higher low. So on the daily chart, we want to start our trend count from the weekly higher low. All right, so let's go back on down to the daily here. And that higher low is going to be right here. So as we take a closer look, when we're starting the trend sequence from here, we have low, higher low, higher low. We have high, higher high. It's nuanced, but it's there. And then a higher high with the breakout, or I should just say continuation, on the Monday session. So this segment of the chart is definitely in an uptrend. Is there a risk of a daily trend reversal? I would say the answer might be yes here. There's definitely more weakness on the daily bar. On the Tuesday session in small caps, we know that these are always more sensitive to economic data. And you can see that we did not close a hammer candle. We did not close green. We closed underneath the opening print. The upper wick rejected a very key and historic level here in the IWM. This level at 196.50 was previous support, then acted as resistance here. And in this segment of the chart, if you recall, right, every single time we opened above, there was no higher low found above until the FOMC day, and then Jerome Powell, with his magic sequence of words, wiped it off the face of the chart, right? We were no longer respecting that 196. So on Tuesday, there was a very real threat here in the upper wick with the week close towards these lows. I'm not going to say it's an equal low yet. If you start with some sort of trend line like this, we're still above the trend line offering a higher low, but the threat was at least there for substantial damage being done to the chart, because remember, Monday is a breakout of, let's just call this as the double bottom, right? We called this in the Saturday update video. The double bottom neckline broke out on Monday, so that's bullish. The best retest would have been retesting the neckline, then getting continuation. So being back down underneath that level starts to make Monday look like a failed breakout. And now all of a sudden it's all eyes on the equal lows. If we were to have broken down there, you have a fake break trapping buyers, and the floodgates are open in the downward direction, no longer offering a weekly higher low. So that was the big threat on Tuesday. And again, sellers did have the edge, much more of an edge here in the Russell 2000 compared to the NASDAQ or the S&P. Now, on Tuesday's session, similar to the NASDAQ, right, we actually recaptured that key level with a strong lower wick on the daily bar. We've closed the gap in its entirety. We're basically unchanged on the week to the close of last Friday. So sure, we've undone the CPI move to the downside, but we've also undone the break on the Monday session. We're back to basically flat here. So as we walk forward, if this trend is going to continue, we want to start working back up towards the equal highs, and that's going to be closer to 203.75. How do we do it? Let's take a look at the hourly time frame chart. So again, the point of walking through that on the daily is just to illustrate that there was, I should say, a large threat on Tuesday Tuesday, which I don't want to call it evaporated. We're not out of the woods here, but we're certainly feeling much better with, look at the lower wicks on those hourly bars, right? The higher low there above this level, again, 196.50. We gapped up above, no higher low, so on and so forth. Here's the FOMC. Jerome Powell breaks us down. When we get in here, much more confidence inspiring. So once again, to be underneath that on Tuesday, red flags should have been going off. You're thinking to yourself, okay, here comes the potential for a trend change. This, really speaks volumes. The lower wicks on today's session, the closure of the gap overhead. If we're thinking about very short-term trend in terms of a 2-bar trend happening here, we have lows, higher lows, highs, equal highs broke out to a higher high into the end of today's session, closing the gap all the way. A little bit of a gap fill reversal would not be unreasonable. Very, very possible that we see some sort of mild pullback that looks like this, as long as the higher low is over this breakout point right here at 197.65. Beautiful. We're looking for continuation of this hourly trend to ultimately work towards the daily equal high, towards that zone we just talked about, 203.75. Where do the sellers build their edge? Hopefully you guys can answer this one, right? It's going to be underneath this key level right here. Sellers will build back their edge on lower highs and price acceptance underneath 196.50. From there, the break of this sort of trend line, if you will, really opens the door for a weekly failure of the higher low. Let's take a look at the anchored view apps. I will not forget on our IWM and small caps. This is really supportive of the idea of 196.50 as long as we're above that, not the end of the world. And if this anchored view app from the high of the Monday breakout can support at 197.65, even better. That's looking like a really solid hold there. Let's come in with the Fibonacci's from the low up to the high. And here you can see, again, what was the threat? A larger threat was here in small caps. Notice we're underneath the 61.8 even into the close. So, if this, again, think about it like this. If the sellers were going to make something happen, the stars aligned for them on Tuesday with solid gap down, some intraday momentum, a very weak close underneath the 61.8. At that point, we had closed underneath all the key anchored view apps, right? So if the sellers were going to make something happen, a lower high here, a double top rejection at this area, and immediately trading back down to the equal lows, that's what the sellers were looking for, simply did not take place. So therefore, the gift is re-gifted back to the buyers. The buyers do have the upper hand, I would say, here as we head into the end of the week with the possibility for a higher low or straight up continuation looking for that 203. We know that we're watching 196.50 to change our tone. Let's take a look at the Russell internals. Strong volume outflows, not as strong into the market today, hardly getting towards that trend higher zone, up around 125 million. Advanced decline line, a little bit of damage earlier in the session, but closing strong at least into the afternoon session here, well over correlated on the Tuesday. And of course, the same commentary down below in the cumulative ticks, very strong on Tuesday's sell side read. Again, making sense there. We know that there were more risks there. And today, mild move back in the upward direction out of the cumulative build. Again, I would say that we're back to about flat, almost unchanged based on Friday's close of last week. So almost like we're just given another opportunity for a new, scratch. Call it scratch. We're watching for upside. We're watching for a higher low here, and we'll see if that can unfold. If not, we will change our tone when it is appropriate underneath that 196.50. We've been very clear about this at this point in time. For the broad market rotation, let's just make a note about this. If the IWM catches the higher low and continues up to the equal high here, closer to the 203, as the QQQ pulls back, your S&P 500 will not collapse. All right, so do not forget, even though we've had this CPI wrench thrown in the mix, the S&P, as long as we're getting rotation in tech itself in the core list of companies, right? Or in between tech and the small caps, the S&Ps will not suffer a devastating blow as long as there's some rotation taking place. When everything is red, down 2%, on the day, and it's across the board, small caps and tech, there is no rotation in the core list. That's where we spell trouble for these spiders. Let's take a look at the market profile to finish up our Russell look here. Not much to comment on other than perhaps that the value area and point of control did migrate higher with price out of the Russell. So if we are looking for overhead supply on any of the indexes, it would make more sense to me that the Russell pulls back first if there's any mild correction that takes place on tomorrow's open. All it will take is drifting underneath that point of control at 2017.30. If we break down from that, I would expect that stronger test of this breakout level here, which is 2,000, by the way, in the Russell futures. That's going to be the equivalent if we head back over here to your level at 197.65. Let's continue talking about rotations, but this time in the context of the S&P sectors. Who was leading, who was losing, and where was the weight? The XLI industrials lead the pack up 0.84%, followed by communications at 0.54%, and then it's healthcare up 0.19%. At the bottom of the barrel, it's the real estate sector, really rate sensitive, getting walloped on that Tuesday session via the CPI news, down 1.71%. Huge hit there. The XLK is not any safe haven either, down 1.42%. Tech, of course, is sensitive to rates. The 10-year really taking a move in the upward direction on Tuesday's news. And then it's discretionary. So some of the heavier weight risk on sectors are at the bottom of the barrel, namely tech and discretionary. But as we rotate or try to find, I should even say, a daily higher low, we are seeing communications and industrials towards the top, not utilities, not consumer staples, not energy, not materials. Remember that these, although not risk-off sectors, they're definitely lightweight in nature, so it's not great to see them leading any push back in the upward direction. So it's not, the rotation is not bearish here, but it's definitely not as strong as it could be coming off of this higher low. We'd like to see some continued performance out of the XLK, but what are the structural charts? Like, we're looking at percentage points, but what do the structural charts actually suggest? The XLI breaking to a new all-time high. Of course, that's got to be bullish. There's no ifs, ands, or buts about it. Certainly can afford a weekly higher low up above the previous all-time high, or daily higher low on a gap fill reversal is good to go here. XLC, what's happening with communications? It's really just sideways, right? If there was going to be a larger threat on that Tuesday gap down, why didn't we rotate through the thin structure? Remember that this represents virtually no price action. The sellers actually had an opportunity there, rejecting this as overhead supply, closing right on the level. Today could have been an open in range and then breaking down over here. Simply did not take place. So are there stronger sellers in communications? The answer is absolutely not. If anything, this to me starts to suggest look below and fail. We're at the top of the range. Can we take out the top now for continuation? So this chart actually strikes me as being even more bullish, like offering a bullish continuation setup instead of just not bearish, right? Next up is healthcare. What's happening over here? Again, bull flagging at all-time highs. Although, yes, this is a risk-off sector, it's the second heaviest weighted sector by market cap. Of course, if any of the risk-off sectors are going to outperform, this is the one to do it. So no issues out of the XLV. Next up is financials, continuing to consolidate sideways in this range, still willing to give them the benefit of the doubt on a breakout over 39.50. That would continue a risk-on look for the marketplace. As we're just stuck sideways in this range, it's not really going to mean a whole lot for a breakdown. The bears needed to see, a material impact from that Tuesday move to the downside by either breaking down underneath this level, closing in here, or offering some sort of lower high setup. It's just not on the table here out of financials. Utilities, what's happening over here? Lightweight sector, also more risk off in nature. Is it outperforming the market? Absolutely not. Is it stuck sideways in this range? Sure is. Downward pressure is going to be downward pressure. Upward pressure is going to be upward pressure. It's a lightweight risk off sector, so it's not the end of the world if it's just chopping sideways in this range. Really nothing to talk about in utilities. Does not look like a threat. Real estate, dip to toe inside of this range, trying to work its way back out. When we get to the 10-year, we'll explain exactly why this is almost the inverse of that chart. Next up is going to be XLK. What's going on with the tech sector? The heaviest weighted sector of them all. The only reason this is red on the week, if we're thinking about this chart structurally, great, looks awesome. Higher high, pulled back, daily higher low, fantastic. The only reason it's red on the week to the magnitude it is because Friday's close was basically the all-time high. We did not get continuation and then the pullback. We just sort of got this flat move, pulled back, again, still offering a structural higher low. We're basically right back up to this breakout point. If we can get back above it, looking for a higher high. So is there any red flag in the heaviest weight risk on style sector, even though we're down 1.42%? The answer is just absolutely not. There's no issues. There's no cracks in the armor out of this. I mean, if we reject for a lower high, will we change our tone maybe over time? Perhaps. We're just not there yet. Next up, we've got XLY, consumer discretionary. What's happening in this name? You can see that we've got ourselves just, again, a very clear higher low. We are respecting the daily 50 SMA. No issues out of this chart. If there was going to be more damage done on that Tuesday session, we should have been in range, chopping around. This is a look above and fail. We're trading at the bottom, threatening a breakdown. It's not the case in any of these stronger charts that offer a risk-on sentiment, namely that XLK and XLY. XLP is up next on the block, and then we've got a couple more to go here. We've got this as a beautiful higher low. It is a D for defensive sector, so it is not something that we want outperforming. Is it outperforming when you look at this chart relative to the XLK? Absolutely not. We've pulled back. It's pulled back with the broad market itself. It's not the first one pushing to new all-time highs or even through the highs, so not really an issue. We're moving along. Next up, we've got the SMH, semis. How do semis look? Again, any issues here? No. I could almost just simplify this entire, video by saying structure's fine, everything's fine across the board, no need to tune in, we're good, right? But I'll give you the context instead. So there's the SMH over 196, no issues. XLE, energy, stuck sideways in this range, no issues. Next up, XLB, materials, lightest weight sector we have. Any issues? Absolutely none, sideways in the range. Let's take a look at the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. I would argue that there are no red flags about risk off, but it could be better for risk on. The XLK is still over an upward sloping 50 SMA, so that's okay, but we'd prefer to see it outperforming, offering some sort of trend here. It's really just kind of stuck sideways in maybe this type of compression. If it breaks out, of course, that's helpful for the risk on and bullish look. XLF, we know that the structural chart is compressing in range. When and if that breaks out, we would like to see it recapture the 50 SMA. If we break out of the structural chart but do not recapture the 50 SMA here on the ratio, that would leave a little bit to be desired. The XLY kind of speaks for itself, trying to grind an uptrend here but still underneath a downward sloping 50 SMA. Leaves, again, a little bit to be desired. Is risk off a threat, though? Not really, as the XLV is near all-time highs. This isn't doing anything incredible or like, oh my goodness, watch out. This, of course, is rotating in the downward direction. So that was healthcare. This, of course, is consumer staples. This is utilities, not a threat. Energy, certainly not a threat from a lightweight performance perspective. Even real estate, seen as a hard asset, potentially defensive there, underperforming. The XLC, trying to curl higher. It's definitely a risk-on sector, but it's just not nearly as heavyweight as something like your XLK, XLF, and XLY over here. Let's move along and take a look at some specialized ratios. We've got the XLK SHY. This is bullish in nature. It would suggest that XLK is outperforming the incredibly safe SHY short-term yield, right? So no surprises here. This is bullish and risk on. Same commentary in the XLK XLU. Tech is outperforming utilities. Utilities seen as a yield farming sort of instrument, if you will. Certainly not in the face of higher short-term rates. But anyways, here's the XLY over the XLP, trying to align more so with the higher low idea here on the recapture of the 50 SMA. This is bullish and risk on. And the latest and greatest addition to the lineup is the SMH over the XLV. So risk on versus risk off. And of course, this is acting more of a risk on indication. People are like the general idea, just for the folks maybe unfamiliar, is that there's a preference to rotate into semiconductors compared to the more defensive XLV healthcare. The reason we chose this pairing is because the SMH is about as risk on as it gets, and the structural chart itself is sitting at new all-time highs, as is the XLV. It's not in the gutter like our XLP or potentially something like the SHY, which of course is more risk off. Same thing with, of course, the XLU utilities. Let's move along and take a look at some interest rates and see what's going on from, actually, dollar first. I forgot my own lineup. Isn't that incredible? The dollar has broken out on the Tuesday session. Of course, the news there that the CPI came in hot, the expectations that the Fed will not cut rates in the May timeframe. We'll get to the ZT and the tracker tool in just a moment, but this tightens financial conditions. So again, no surprises with the gap down on the Tuesday session. And now that so this is the next takeaway here, is really that the dollar matters when it matters, and then as you're just consolidating sideways, it doesn't matter anymore. And a great illustration of this is, of course, this move higher causes the gap down. We're sideways. Technically, we did not pull back aggressively or unwind the move out of the dollar. What drove the trade today is the rotation actually taking place over here in NVIDIA. I've queued up this chart specifically for this moment. Notice that when NVIDIA tops, that's when the market tops. When NVIDIA bottoms, that's when the market tries to hammer out this sort of bottom over here. It's almost a mirror image, right? So if you want to determine when the market's being driven by NVIDIA versus outside factors, just look at them one-to-one. Does NVIDIA's chart here mirror the S&P? I would say absolutely. What happened on the Tuesday session? Not so much, right? NVIDIA, there's your sort of rally. The S&Ps did not fare so well, so you can make the argument that the market really cared more about the dollar on that particular day. And this rotation, again, it's all about the rotations under the current circumstances where there's one stock to rule them all, like your NVIDIA. Let's go back on over to the dollar and see if we can get any takeaways from gold and whether or not this is offering any ideas. At the bottom end of the range, I would love to see some support here off of 2,000. If we can hold that, that in theory would put downward pressure on the dollar and therefore alleviate some of the headwinds for equities down below. So I would say if gold can catch support at 2,000, that is bullish for equities based on the dollar relationship, unless it's just going to be NVIDIA, the one stock to rule them all, driving the S&P into the end of this week. Let's see what silver has to say about that. Any sort of confirming indications, denying, or contrarian indications? Not really. really. Still in a downtrend here, but trying to hold on to this level. So as long as we can chop here, if gold gets the rebound off of 2000, that would be bullish for equities down below. Moving along, what do we see out of the TNX? Here we go. This is the chart. You really start to want to watch this on a weekly time frame chart, right? This is the level. It's all about 4.33 in the 10-year. Can we find a rejection around this level, offer up a major lower high? In my eyes, it sort of seems inevitable considering that Powell is going to cut rates at some point. We just don't know when. So watching for that lower high to form will be pretty informative for the tech sector as a whole to alleviate some of those headwinds that we've just been discussing as the Tuesday move happened, obviously in the upward direction here out of rates, but downward direction out of the market. You can see how this basically mirrors the dollar. There's your break and just kind of sideways on today's session. So the biggest issue that could actually unfold, let's talk about risks out of rates, right, is if we find a higher low over this level, which what's that number? Let's go ahead and drop that in the chart here together. That's going to be somewhere around 4.2, I believe. Yeah, so let's call it 4.2, round numbers only up here. Oh, we missed it by about a penny. So 4.2 is technically the 10-year rate. On the TNX, it would be 42, what looks like dollars. This consolidation and a break, that to me would start to imply, okay, look out below, not helpful at all for the S&P. If it breaks down underneath that level, that's like a big sigh of relief for the market. Headwinds are alleviated. And again, maybe gold has something to do with that with the dollar. We'll watch out for that. As we know, we are getting some pretty important economic data on tomorrow's session. We get retail sales as well as the unemployment situation, initial claims. We'll get into that economic calendar in just a second. But here's the Fed tracker tool, heads up indication, which is the inverted ZT. There's your strong break. This is basically telling us there is no way, not until hell freezes over, is Jerome Powell going to cut rates in May. Let's see if that holds up. Take a look at the tracker tool. So yeah, hell would just about have to freeze over for a cut in the March timeframe meeting, but as you can see in May, maybe about half frozen. Nonetheless, after the CPI release, these numbers have just about flip-flopped where we had about 39% odds actually for a pause in the May timeframe and higher odds of a cut. Now again, those have flip-flopped and we're dealing with higher odds for a pause. So what you'll start to see is instead of pricing in the anticipated 6 cuts we were expecting for 2024, we are now all the way down to 4 cuts in 2024. And all of this is on the heels of the economic data that CPI came in hotter than the expectations. Here specifically on the core, we get big contributions out of shelter. And remember, shelter is the stickier side of inflation. Really, services is the stickier side of inflation. And look at the huge uptick out of shelter inflation. That's in purple here. I have to imagine that some of that is due to first of the year leases that are starting to sign in January. Maybe December was a little bit skewed to the downside. Not many people signing leases, trying to build demand. So, we reduce some prices or whatnot. But January is right back in the upward direction. Big increase there. You're also getting a big increase out of transportation services on the month-over-month read. Like not a lot was happening in December. Maybe that's a seasonal thing. But regardless, huge increase on that. And all put together, all said and done, we did see CPI miss the expectation. The annualized numbers are flat. The annual core CPI came in flat, right, which is fairly important. And here we can see some, again, just a further breakdown of how shelter has not done what we need it to do. Of course, goods inflation has come down substantially. You can see all the madness in here when everything was just out of control. But notice that a sustained shelter inflation, somewhere around about 1%, is more so what we're looking for. We've got about, we've got to cut this in half. We've got to cut where we're at currently in half in terms of inflation pace. Obviously, your rent is not going to be cut in half, but the pace of inflation there needs to continue to fall by about 1%, half of the 2% that we're getting. So we're still not all the way home. And it's not unreasonable that Powell sees this information. And actually, he's going to be the guy who comes out on top saying, hey, we wanted to see data continuing to improve. Hey, we didn't see the biggest improvement on the latest release of CPI. So he's going to say, I told you so, right? We're going to stay higher for longer. And maybe he will ultimately have the last laugh from all the folks who are like, hey, cut rates right now. You're going to break the labor market. No, the labor market so far is doing all right. If we take a look at this, we are going to get those unemployment claims tomorrow morning. And we're not expecting a huge blowout number. Remember, huge red flags start to go off if we breach over 250,000, but we have not done that in a very, very long time. The expectation here is for 219,000. If we just open up this chart, you can see. Let's get a more appropriate scroll. 250 is up and over this as a threshold. And if we just look at where we're at currently, we're not there. we are not even at 225, right? The trend is slightly higher, so we're keeping an eye on it. But as of right now, not a huge threat for the end of the week. This, to me, is going to cause some volatility, but nothing more. I would really watch out for the PPI on the Friday session, as well as maybe not consumer sentiment, but definitely inflation expectations on the heels of the hot CPI. Remember that PPI, generally speaking, starts to forecast what maybe the next CPI starts looking like. And if people feel like inflation is heating back up, that starts to also contribute quite literally to inflation. So we want to watch to see if PPI comes in light or if inflation expectations come in light. This is a pretty good move as we take a look at the expectations here. We have been declining here. We want to see that trend continue. Otherwise, again, red flags start to go off. That's really the fundamental story for the end of this week. Here's the earnings calendar. Tomorrow before the open, put your Crocs in sports mode, maybe John Deere if you've got some farming to do, but nothing major, nothing really market moving. We've got Coinbase and Roku, honorable mentions there. The trade desk, maybe Applied Materials from a chip making perspective, the actual production. We'll watch out for that. And nothing really catches my attention on Friday. Let's take a look at risk appetite. All right, let's get back to being objective here on the technicals, whereas the fundamentals, as we all know, can somewhat get subjective at times. So the TLT ratio to the S&P is not suggesting an imminent flight to safety or any massive shift in risk appetite away from equities. This, of course, is a bullish relationship for the S&P down below. If we take a look at bonds in relationship to themselves, no big changes over here, continuing to drift into short-term uptrends, but we've already clarified our stance that these are really just opportunities for people to get short-term yield before rate cuts are ultimately on the table. The main reasoning for that confidence is just because of what we have here in credit spreads, not initiating any sort of credit event or suggesting a credit event is likely. Credit risk seems to be fairly stable at this point, even amidst what we saw out of New York Community Bank. Let's take a look at the HYG in isolation. It continues to suggest a divergence happening here, along with the extreme higher highs, right? So lower highs paired with higher highs out of the S&P. It basically tells us that we want to be cautious near higher highs. Remember that participating on higher highs is oftentimes very difficult because the risk reward isn't always there. We don't know what our target ultimately is moving into blue sky territories. And if our risk is not well defined because we're buying the highest high, no good. So as long as this is divergent, we'll sort of stay away from higher high breakout trades. But if we're going to have structure to play against in the S&P, I would not look at this as something to say, okay, we're only looking for shorts because the HYG is divergent. Is it a bit of a red flag? Absolutely. But it's not enough to say, hey, short the S&P right here, right now. Not the way that that one works. Let's take a look at Bitcoin. It's breaking out big time. I think we've breached 50,000. Yes, we have. Back over 50,000 in Bitcoin would speak to somewhat a stronger risk appetite for financial instruments as a whole. Let's jump on over to breadth. New highs versus lows has certainly suffered on the gap down from Tuesday, but the key takeaway here is that we remain over the zero line, just as a reminder, in the early stages of a trend recovery. Remember, break of the previous all-time high, break of the previous all-time high, yep. We're over the zero line, but nothing impressive in the first little bit. You just want to stay positive, and we are as of right now. What about the SPX A200R? Starting to slip a little bit further in the downward direction. Last week we were flat, so again, no surprises considering Tuesday's move. Same thing here out of the SPX A50R. However, this is where the rubber hits the road, right? We need to see a hold of that 50% mark. Otherwise, starts to raise more red flags about the ultimate breadth of the market down below. The RSP equal weight S&P 500 is, however, like this is the shining light that continues to suggest to me at least that it does not make sense to be a new money short in the market. Although the SPX A50R is near that 50% mark, notice that this is still consolidating near these highs. On the breakdown from Tuesday's session, right, as we were getting this gap down, we did not violate the key structure at 155.50, and today we're following it up with a gap close to the low of the Monday session. If we can get back up and over this level, again, there is absolutely no reason to expect that the S&P is going to break down because of a breadth concern. Breadth right now is fairly stable in the RSP. This, again, really, really continues to light the way. Whenever there's a substantial move in the market, always consult this chart if you're someone who's concerned with these type of data points. To me, very substantial. Next up, QQQE. Certainly still hanging in there. It's about a 1-to-1 with the weighted down below. This is not an issue. It's not been an issue for a while. What about the Dow? Dow is suggesting some weakness here. Definitely not trading back up towards the equal highs, much weaker on today's session, weaker close on the Tuesday gap down. So transports are telling us to take a little bit of caution here as well, but just like I would say the HYG, this is not enough information by itself to go out and short the S&P 500 looking for a turnover at this high. Let's move along to volatility, a little bit of a squeeze up and over 15, but no issues, right back down underneath 15. What about the precursor to volatility? The VVIX, volatility of volatility, is certainly still suppressed. It did not move up and over our sort of acceleration zone at 103. We're not even at 75 as a complacency sort of effect there. So all good out of volatility. We did update our futures, VIX futures contracts here, and these are still in strong contangos, just not even close to the zero line here. 9-day VIX is certainly suppressed as well. And you can see the 1-day perked up a little bit on that Tuesday session, but honestly, the Monday session, the 1-day VIX was higher. So, you want to talk about Tuesday not being the end of the world, not really being any substantial progress for the bears. This kind of tells the story right here out of the 1-day volatility. Let's move on over to skew, and then I've got an interesting options chain to show you. Let's take a look at skew, and it's just printing new highs. It's printing new highs. So even with that breakdown, that's, this is telling us that people are loading the boat on puts, or at least the implied volatility of out of the money puts is higher than the call side. People are very skeptical of the rally. And what do we know that does for the market, right? As long as there are shorts that need to be squeezed, we will keep pushing in the upward direction as long as the structure itself suggests that the buyers are in control. Let's jump on over to an options chain of NVIDIA, because I think that this is just, it totally illustrates what's happening in this market right now. Look at the implied volatility. Let's not even worry about out of the money right now. You could look anywhere on this chain. It's the same point. But let's just go at the money, right? What do we see on the at the money put side versus the at the money call side? Right now, this is suggesting that there's more risk on the upside than there is the downside out of NVIDIA. So if you're someone who says that the music can't keep playing, take a step further, look behind the curtain. It certainly can based on all of the indications we've covered so far. If you've made it to this point in the video, I appreciate you coming out to the analysis on a Valentine's evening. Hit the thumbs up button, subscribe, all that good stuff, and let's kick off the core list of companies with none other than Apple. We can certainly see that the lower highs are building here on the daily time frame chart. Nice rejection of our 50 SMA, but on the contrary, we do have some semblance of support here near the daily 200 SMA and this level at 184. The hammers would suggest to me that it wouldn't be unreasonable for some upside, but as we've been talking about for the past couple of days, the setup in Apple is to watch for this to act as overhead supply. If we can close this gap overhead from the Tuesday session and reject for a lower high underneath 187.50, I would be looking for at least the equal lows, if not an equal low breakdown, and some sort of follow through into these lows at 180.25. Let's take a look at the hourly time frame side of things just to understand that there was no recovery effort here like there was in the QQQ or in the S&P 500 by itself. It was lower out of the gates, it stayed lower, and now you're getting a little bit of lift into the close, but certainly nowhere near these highs. Again, if there is a break, if there is continuation of this trend, that to me would be the preferred outcome based on this relative weakness and using this as overhead supply. Let's move along and take a look at Microsoft. The daily time frame chart doesn't really do this thing justice, so let's just keep it on the hourly. This as a balance range, we can see buyers are stepping up near the lows. An inside bar on today's session. This range is completely contained within the Tuesday range. So very simple. You're either looking for a continuation to close the gap overhead or further consolidation. I would really be patient out of Microsoft for the bearish trade until we are forming lower highs underneath 402.75. Right, lower highs there. Sure, we can start to look for moves in the downward direction with a little bit more confidence as of right now. Just still not really on board with the short ideas yet. Maybe this ultimately turns into a head and shoulders. We're yet to see, but there's your neckline anyhow underneath 402.75. Next up, we've got Google. What's going on with the Goog? More so similar to, I guess, both Microsoft and Apple, perhaps, where we're getting an inside bar, so a 2-day range. If you can break the highs, maybe there's something going on to the upside there to close the Tuesday gap and then maybe work up towards this earnings gap again at 149.25. Any further consolidate, it's really just a consolidation play. Very simple stuff. Higher low above, lower high below. You want to chop around in the middle? Be my guest. You're not really going to get the stronger move when you're in between 146.15 and 144 flat. So don't overcomplicate that one. Wait for the break of the 2-day range at this point. Next up is Amazon, getting a little bit more lift into the close on a break of the what was likely going to turn into 2-day highs, starting to break into the afternoon session, their last hourly bar, which is technically 30 minutes. If we get a little bit of lift here, just looking for the top of the range. So I would be watching Amazon quite closely actually tomorrow, since it's already suggesting a break breakout over what could be construed as, ignoring this wick here, some sort of 2-day range, right? If we can clear those highs, if we get acceptance over 170.25, looking to continue to trade this one in the upward direction. Sellers, again, it's got to be something in the gap before we start getting aggressive there. Next up, what's going on with NVIDIA? The one stock to rule them all. We now have 3 highs flat across the top on the hourly time frame chart. So keep it simple. Higher low consolidation over 731. My goodness, how about $731.25? Consolidation in there is very bullish. Break higher low over this, which is the all-time high, 741.25. Again, the music keeps playing. The funniest thing that could happen here is if they miss on earnings, right? We're not going to bet on that, of course. You wouldn't want to step in front of a moving freight train, but if they miss on earnings, oh my goodness, like the world's going to implode, right? Everybody who thought NVIDIA, the one stock to rule them all, was just going to go to the moon. Now all of a sudden, okay, who's left holding the bag, right? So we're going to watch out for that. Earnings are next week. It's not a contender just yet. And if we're just looking at the chart objectively, looking at price action, trends, and price analysis together, this, as we talked about, that's your bull trade. If you're trying to short this thing, maybe there's something, but I would wait patiently for a lower high clearly defined underneath 722. Maybe, just maybe, you get a little bit of a daily double top activity there, falling underneath this, turns everybody into overhead supply, thin structure to rotate through. So 722 on the downside. Next up, Metaverse. What's going on with Zuckerberg's Fantasyland? Not so happy with the Apple Vision Pro, apparently. Anyways, again, very simple stuff. Range here. A lot of these range-bound charts are going to, you just want to watch. You want to watch the same concept on all of them. Can we get range expansion here by breaking out with a higher low over 473.50, or will we rotate back down to the bottom, 466? Based on this lower high that tried to form on the Tuesday session, and then today completely consolidating above, I would be more partial to this unfolding higher. So we'll watch that one in stride. We'll take it in stride. 473.50. Your target is going to be up here at the gap up from earnings high at 481. Let's go 482. You guys know the rules up here in the penthouse. Round numbers only is rule number 2. Rule number 1, if you know it, drop it in the comments section. Next up, we've got Tesla as we wind down the video. This as an inverted head and shoulders, absolutely. Neckline way up there at 193. Gap to close overhead, absolutely. Are we there yet? Not quite. So watching for this to get there in the first place, consolidate and then break is an opportunity, or just a straight break. Then we would want to be players on the higher low attempt to really confirm prior resistance, basically the neckline as newfound support. So 193 key watch out of Tesla. If you're just trading it in this range, not really thrilled being in the midpoint. I would prefer, if you're looking for shorts, if you're looking to play ping pong, just wait for it to get here and then initiate your short stop entry and then some sort of target lower. I would really, out of Tesla at this point, watching to see if this wants to resolve. If not, we'll take it in stride and really comment on whatever the next pattern is. Next up is Netflix. What's going on with Netflix? Netflix resolved this range in the upward direction more firmly. So now there's 2 outcomes, either straight up continuation over 579.20, looking for, it's not quite blue sky territories. We do have 585 to contend with, and then beyond that, 616 is the next large target. So there's a lot of room to run in the upward direction. You do not have to be the first one in the door here if this is ultimately going to break in the upward direction, right? So opportunity number 1 is straight up continuation, looking to align with this, or if we do get a pullback, probably not looking for the short opportunity here, but instead looking for the buying opportunity at 569. The only issues I have with that potential idea is if you take the hourly chart down to a 15, you already got this as a retest intraday, right? Your opportunity was there on a 15-minute double bottom for the hourly higher low pullback. So we've already tested that level. Probably don't want to come too firmly into it again, but willing to give the buyers one last attempt on the hourly chart. You can't spend too much time there considering we've already interacted once. All right, 3 trade ideas and then you are on your way. JP Morgan is back on the radar. It was really never off the radar with this consolidation high. So just putting this one back on your watch if you sort of took it off maybe on the Tuesday gap down. Financials, they're holding in there, right? So this idea came from Saturday. It's still on watch over 176.25. Next up, we've got DDOG, Datadog reported earnings, DDOG, if I could spell, there we are. Beautiful flat top here at 137.50. And I do believe, yeah, we've got to take a look for some structural targets off to the left. I mean, that's we're on a monthly chart here. Just keep that in mind. Let's go to maybe a weekly, see if we can refine that. Still pretty accurate here. How about a daily with lots of price activity that we can look back at? We really just want to get granular and be able to see where we're running into the potential. Yeah, this needs to capture our attention, right around in here. That's what we're looking for. So 142 let's go 75 on that. 142.75 there we are, is going to be your upper target on the break of this potential level here. Certainly reasonable. You can see that we can travel that range. It's not, unfathomable that we could do something like that over the span of a day on a breakout of the level. So watching that for the upside, not interested if we're just stuck chopping around, right? We'll continue to keep it on our radar as long as sort of this support trend line here. Daily 50 SMA is going to be a good proxy for that. As long as higher lows continue to evolve, we'll keep it on the radar. If it breaks that, off the radar, not as interested. And then lastly, we've got Home Depot. HD is the ticker on that one. And we've got a gap to close overhead after 2 back-to-back daily hammers, right? So long lower wicks suggesting that buyers are stepping up. If we can crack the flat highs, looking for follow through, that's going to be over 359.50, closes at 364 flat. That's likely going to offer some sort of scalp in there, and then we'll take it in stride. You don't have much going on from a higher time frame perspective. Maybe someone out there would call this a bit of a rising wedge, so you're concerned from that point of view. That's a bearish pattern technically, but I would be watching for the gap to close overhead, especially if the broad market is going to be bullish into the end of the week based on all of the data points that we've collected in today's episode. That's going to do it. If you enjoyed the episode, let me know down below in the comment section or by giving the video a very simple thumbs up. We will be live for the pre-market prep tomorrow morning at 8:15. We hope to see you there. Maybe coffee and donuts on Friday because number one, it's a Friday, but number two, we've got PPI coming out, so you can come hang out with us again 8:15 here on the YouTube channel, free and open to the public. And with that said, folks, have a green trading week.